It is May from Markets with May, and today we are going to talk about Lennar's earnings call, which happened last night. And even though I have no positions in Lennar, I always listen to the home builders. First of all, Lennar is the first big home builder that comes out. And because housing is such a huge component of macro, because residential, et cetera, such a huge part of getting macro right, particularly right now. I think anyone that's a macro person that doesn't listen to the home building calls in what's right now the off season is missing it. This was a great call in certain ways, but in other ways, I gotta say, I really feel like the analysts were half asleep at the wheel, or they've just made way more money than I have for the year and they're clocking out because there were so many oddities in this earnings report and none of them got answered. But from what I listened to on the call, reviewing all of the docs, this is what I pieced together is actually happening in home building and what it means for macro. Okay, I checked everything and somehow I have no skin in the home building game right now. So this is purely me telling you macro and there's no conflict of interest here at all this time. Past performance is not indicative of future returns. That's the disclosures. Let's get into what happened and what it means for macro. Okay. Lennar. All right. So in the quick, the earnings numbers weren't great, even though the street is pretending like they beat estimates and they did fine. They did not do fine. Okay. Let's just call it as down 1.8% in revenue. Operating income was up massively. So you got this down. Oh, sorry. Let me get the wrong slide. Hold on. You need this slide. Down 2%. So just 1.82% for revenue. Operating income was down 20%. And I am going to go through this because it's actually really important what piece of operating income was down. And then net income down 24% was not a great quarter. However, for whatever reason, somehow that was better than other people expected. And in fairness, last year was tough comps. I had been bullish in home building all of last year because I wasn't seeing the slowdown. Plus, I was seeing rental continue to do really well. But then because I started to hear sniffles about like basically sniffles and sore throat is the equivalent of what I heard in multifamily. I pieced out of these sometime earlier. But this was a bad quarter. It wasn't a terrible quarter if we consider that we're comping against a rough quarter, but it wasn't great. And let's talk about the precise way in which it wasn't great and what I think is happening. Okay. Revenue from homes was down, but they sold more homes. I'll go ahead and preview that. And we'll talk about exactly what happened there. And then the profitability of the homes was only like costs were only up 5%, even though revenue was down 1.8%. And you got to really look at this mix. So the mix of it really tells you a hint of what the actual strategy is versus what they said on the call. So you have cost of goods sold on homes 32% versus 41%. Profit on the land was up 9%. And, if you do that number divided by that number versus they were taking L's on the land before. And then SG&A was up 19%. Okay. Home prices down like crazy. Let's just take a break and just really absorb what that means. You have home prices. Down essentially on the quarter, which I'll show you in a second. You have costs mitigating, but somehow you're taking profit on the land. The hint is the land, okay? And what exactly is happening on land and how do you think about land as to what the actual strategy is, which I think is not what they talked about on the call. They talked about on the call that they lowered the price of houses because they wanted to take market share. It's not Nabisco, my friends. It's not a bag of potato chips. You don't take market share because if I buy a Lennar home this year, I'm going to think about Lennar in 5 years. That's just not how it works, or next year. I'm not buying houses on the continent. So something else is going on here that I'm pretty sure most people missed, at least, or just didn't talk about on the call, that is actually going to be pretty important on the macro front. Now, let me show it. Also, I just want to say the other pieces that are pretty important. Multifamily was a hot mess, but it was a very specific sort of hot mess. Revenues were down 57%. Costs 35%. So meaning that you did have margin compression on top of just bad sales, because you can look at 137, which was the revenue, and 139 and see that's bad. They went ahead and basically sold out a multifamily. That's what that actually is, means, look like, or otherwise. So they were like, we're getting out of multifamily right now. And then financial services is essentially them going ahead and helping people with some short-term lending, construction lending, and stuff like that, so they don't have to be dependent on the banks. Now, this all ended up just fine, but just realize because rates are so high, they're making coin on this, and because they actually have decent funding facilities, this is a beautiful piece of revenue. It's not that big as far as revenue goes, or even operating income, because you can compare it. This company makes money off of houses. It doesn't make money off of financing. And every single big builder learned from 2008, it's not smart to make money off of financing. So nobody's going to do that. So that's what's up. And then on the tech investments, the real estate tech, all those companies went public, so they had to take marks, and they weren't the best marks out there. And so that just looks ugly. It's going to swing around, and it's going to swing around aggressively in this kind of market. I would ignore that, because the tech that's being built in home building, especially the stuff that the home builders themselves are investing in, is probably pretty useful tech, given the scale that they have, how they use it, and what the relationship is. So I wouldn't mind that too much. I mean, I would love to, in another time, go through asset by investment by investment, just see what they have, just in case in the rubble of what's going on right now in the markets, there's some interesting buys in there. But that's how it laid out. But let's actually get into why this home building stuff is really sketchy. It's not sketchy. It's just not what they're saying. Okay. It is not, I'm trying to take share or something else. Our strategy is land light. Okay. That is not what's going on here. And these profits on land, you can see it clear as day. They hid those profits by basically not marking down the home on the cost of the raw materials, but just like being like, oh, raw materials, well, this, you know what, we're just gonna like push the land in there and charge you for the land a little differently, and that's how we're gonna make our profit. That's the truth right there. Okay, so that's what we're seeing, and it really is confirmed when you look at this. And I put the little answer key up there at the top so you could see what they mean by East, Central, Texas, West, and other. Central, for whatever reason, they're including North Carolina, Georgia. So it's really, and then they're doing a bunch of Midwest. So just realize Georgia, North Carolina, Virginia, and Tennessee is all in Central. Texas is its own deal. Texas is a big area for them. You can see the numbers. And the East is Alabama, Florida, Jersey, Pennsylvania, South Carolina, which I think is weird, because why isn't North Carolina the East or whatever? But honestly, even if you were to look at the East, it's really Florida. Can we just call it what it is? It is Florida. Okay. So when you look at the homes, when I said the volumes were up, this is the count of homes, and you can see they did 7.6%. They sold the living daylights out of the houses. This is what the deliveries were. So they delivered a bunch of houses that they sold last year or 6 months ago. Their average time is about 45 days, though, to be fair. So it might have only been a quarter ago, but this is really 6 months ago, for honest, with how housing works. And then they have new orders as well. New orders up as well. Okay. New orders went from 14 to 19. And this is the big kicker, active communities were up 5.3%. Now, for everybody that knows about houses, y'all know that you don't sell houses on the cheap randomly. So they could have just stopped building, and they wouldn't have delivered nearly as many houses or new orders. And if they thought, hey, this market is awesome, and they tried to pretend like on the call, you know what, supply is really constrained, and so we believe that we need to build into this, make America great, make sure there's more housing supply. We want to take share. You don't have to say to that, nonsense. That's not what you were doing. I know what you were doing, because I was alive in 2008, and I'll show you exactly what they're doing. But before that, let's talk about, you guys, these comments are wonderful. Make sure to watch the comments, because I really love and enjoy that. But we will get to the comments in just a second, guys. All right. So I do want to show you why they might say supply is weak. And you've got folks that are all over the map on this. You've got bears and you've got bulls, but let's just talk about what it actually is. All right. For the bears are all going to look at this chart right here, which is monthly supply of new houses. And they're going to be like, oh, the supply is crazy high. and it's monthly supply divided by something else. So this is an adjusted monthly supply versus demand type of number, okay? And it's going to look like, oh, it's higher, you know, what have you. But then the bears are going to be like, or the bulls in real estate are like, no, you don't understand. Inventory came down a lot since 2008. Like we didn't really rebuild that. So here's the 2008 number. This is privately owned housing unit starts. This is single family homes, basically, from 2008, 7 crash. Nothing was built from 2007 to like, well, you call it really, yeah. I mean, right here at this point, you're not building replacement at that point. So 2000, late 2007 until essentially 2016, you're barely building supply in. You're just swallowing up what happened from 2002 with the nonsense that was going on then. And then COVID, you have shrinkage again in the housing and housing starts, which would be new home build, right? And then you get a spike right out of 2020 that's basically what you would have needed for 2021 plus the makeup homes that you're making up for the weakness, and then straight back down. So this is what the bulls are saying when they say there's no supply, is that we really haven't come close to making up for a decade of underbuild. And then this one too, vacant housing units for rent. The rental market is still holding up according to the REITs, which reported 2 months ago. Now, turns out, yeah, that's true. Turns out, and that's interesting, that the home builders on the multifamily, you could see them puking it out basically and not building any more of it as of this last quarter. You could see those numbers like I showed you. They also sometimes, if they can't sell those multifamilies out, which basically the townhomes, they'll start renting them out as well. And they're saying instead of pricing increases on the rent, they are starting to see stabilization against year over year. You guys are writing some funny stuff in the comments. I love it. All right. So realize that the rental market, this is the first guy to come out that has any kind of intelligence since about a month. So it can be the case, possibly, we shall see, that the rental markets start to firm up in the markets that they're in. Now, the REITs were saying there's only really 2 markets that they were having a problem in, and that's Phoenix and Austin in particular, and then little sprinkles here and there, but really Phoenix and Austin were the 2 that were showing weakness. So realize this is the first other sign. All right, but let's get back to what I think they're actually doing, okay? What I think they're actually doing is avoiding what happened in 2008. Now, this is my home area. It's my home county. Okay. So I know this really, really well. Some of y'all know my folks come from this area. Everybody's in construction. Okay. Everybody does real estate in this area. And they're either contractors, GCs, surveyors, whatever it is. My own father was a GC. So I know this area cold, and I know for a fact. So what I have is the pin in the middle. This is what I think is happening. That right there is Lennar property. And right next to it is a bunch of D.R. Horton properties. And what I want you to realize on these Google Maps is that everything in gray is where you see houses. That's where the subdivisions are. And everything in green in my area, that's swamps. So if you don't know how to identify an alligator crocodile, you need to stay on the sidewalk in those areas because they'll get you. This is swamp area, okay? Now it's above, where they tend to build, they've been really good. They've literally drained the swamp. So you're fine. You don't get too much more flooding anymore where the gray areas are. But the point is, this land was purchased in 2008. Okay. Some of it, 2009, 2010, what have you. But these are purchases back then. And what happened was back in 2008, because they were sloppy, these big home builders, they would start a subdivision. And what you got to understand here, if you go back here and we use this chart, what happens, you see how the housing, let's do this. Let's use this. So they buy the land or housing somewhere in here. They get permitting for it. They ask the city to run water to the plots of land. This is the middle of nowhere, right? They ask the city, run the water, the sewage, and the electricity. And then it takes about a year to get the land to actually develop. You got to get rid of the trees. You got to add sand if it's too low, all that stuff. And then right into the crash, they'd only gotten maybe one part of this gigantic parcel done. And they left that subdivision there because they didn't have any cash left. Okay. And because they didn't have any cash left, that subdivision sat there. The prices went way low. And then they couldn't do anything with the land near it because the pricing on those homes were so ridiculous for so long. And they couldn't do anything with that until essentially back here until 2020. That's what happened in a lot of Florida and in a lot of places all over the United States. So what I'm pretty sure they're doing right now is what they're doing is they're basically seeing this potential dynamic, and they're just building out like crazy enough housing in that area such that it could potentially support move-ins, given that you do still have this dynamic going on. So they're willing to drop the price. And I really want to show you this because it's kind of crazy how much they drop the price. And everybody's pretending like it's perfectly normal. Oh, yeah, it's perfectly normal. It's not perfectly normal. Okay. So the average price of delivered homes down 8.7% year over year. New orders, they sold them for 5% less. And they sold them for 5% less, but had, 36 active communities increasing by 5.3%, 36%. So you got this crazy negative dynamic going on in the housing market, but somehow they're finishing up these active communities and building out the area and finishing up homes. Why? Probably because that's the only chance they got to get that land off their balance sheet, build out those things so it looks like a full-on community that someone wants to move into, and then kind of front run any kind of overbuild that might make people interested in the other land. They're not going to leave them like they did last time, where it's basically this rando subdivision in the middle of nowhere. No one wants to live there. Okay. And I think that's the right strategy. And the reason I think that's the right strategy is, unlike last time, this time they have balance sheet. Okay. They have actual balance sheet. I want to show that to you really clearly. Before I show it to you clearly, just to make it crystal clear of why I feel the way I do, you can see this. Even though they delivered 8.7% and built a bunch of new homes, they still have and have been basically they increased inventory. And these finished home inventory is being compared to a falling raw material cost price. So this is actually more homes, not less homes. Okay. And then land under development, you can see, is all land sales. Okay. There is a part within the documents where you can see very clearly they sold land. That's what it is. So they sold land to people buying houses and whoever else they could get rid of the land for. Okay, that's what's happening there on assets. But I'm not worried about them because when I look at it, you do have a beautiful balance sheet. Okay, here's the balance sheet. They used cash is down 15%. But they still have $3.8 million cash. They got a lot of cash, right? And liabilities are down as well. So you got liabilities down just as much as cash. In fact, if you really look at it, you got long-term debt on here that's equivalent to cash. They're going to be just fine, better than fine. Receivables are up 25%. That's a little bit weird because that basically is the fact. It's not weird so much as it really tells you they're trying to build these houses out and get them off as fast as they can, even if they're going to take a smaller margin on it. Okay. Multifamily, just like I was saying, you can see they did try to decrease it a bit, they finished the build out. So up 7.7%. They're going to be fine as relates to balance sheet because they don't have much leverage on this. Okay. This is $1.3 billion worth of multifamily against $290 million worth of debt. They're fine. Okay. They can hold that multifamily and charge whatever they need to charge in rent until they can get it off and running to someone else for a while. And then financial services, and this is most important because in 2008, boy, were there a lot of developers that messed this one up. Financial services is the financing on construction loans that they're giving people. And quite frankly, they have enough balance sheet, which all this tells you, to continue to sell homes and do that for people, which is a competitive advantage. That's fine. Okay. Financial services decreased from 3.2 to 2.3. And also you got, assets and liabilities. This is fine. And this is all because they basically do have a bunch of facilities, which is people that wanted that type of loan that specifically they're doing. They're happy to take it on their books and say la vie. Okay. So right now, very strong balance sheet. So super smart on their part to just try to push out these houses. Final couple of things, because I do have some friends that are in housing, mortgages, everything under the sun. This right here is their debt. And like I said, I'm super cool because they've got, like I said, $3.8 billion in cash. They're getting 21% operating margins on the houses. So the fact that the debt is mostly sub 5%, I could care less, right? They got cash equivalent to the total notional value of the debt. So do what you need to do to try to make sure that these subdivisions are finished versus what you did in 2008. Plus, you're still, you're still paying down debt. So I'm happy. Now, final thing, because a lot of y'all are watching this and you don't care about the home builders, but you might care about your area. This is what they sold houses in like crazy. So you can see the discounting that they're doing that's impacting your own home price. Okay. In the East, again, East is Alabama, Florida, New Jersey, Pennsylvania, South Carolina. They didn't have to discount it as much, but the new houses they discounted at 6%. The houses that they sold when they delivered them down 3.5%. They sold the new houses at 415. Now, if you're one of the people that bought them and you're upset, let's just take a half a beat, because the square footage is part of the way that they're doing it. So it's possible that this 415 incorporates the fact that they reduced square footage, what they told you that they were going to do a quarter ago. So no reason to get crazy upset on that. The place where you really took it the most is out west. Okay, California, Arizona, Colorado, Idaho, Nevada, or Oregon, Utah, and Washington State. All right, and that took a big chunk on the delivered homes, not as much on new orders that are coming out. They're not discounting that nearly as much. So actually, from what was delivered versus what they're selling now, you guys are a little bit happier than the folks over in the East, those eastern states. Texas, boy, it looks like it's awkward in Texas right now. If some of y'all are in Texas, feel free to post it in the comments. Remember, Texas is a big state. Okay, so you might look at this number, you see the average delivery price was $286, and you probably might be like, wait, that's not what's in my area. Just remember, Texas is a big state, so Austin's gonna be different from other places, from Dallas, from Houston. So that's what you're seeing, and so on and so forth. So hopefully that's helpful to some of you guys. And that is what I have prepared. But essentially, it looks like even if we're going to do the craziness of 2008, these home builders somehow are doing it a little bit more responsibly. They're not going to leave those ghost towns or the random development in the middle of nowhere at 2 hours out of town that no one wants to live in, unless you are truly country folk. You guys know who you are. Okay, so I just want to say hi, Grandpa Barney. Love you. Thank you so much for coming. Aw. Say hi to Grandma Barney for me. Let's see who else we got. Gus, thank you for stopping by. I don't think there are any questions. This is more of an uptake. I feel like most of you guys are really on top of this. Oh, wow. I didn't know that. Used to work for the power company and talk to builders. They do. They make more. Yeah, that's true. There are some. Lennar's not that bad, though. I think some of the worst were Dunsky after 2008. But, different states have different, let's call it special builders. Yeah, D.R. Horton, D.R. Horton usually charges a lot. But yeah, I don't know that that's doing more for the amount of dollars that they spend. Lennar tends to be slightly cheaper than D.R. Horton, so that it's a fair comment. And they are massive. Juicy got you crazy. You're hysterical. Thank you for stopping by. And that is it for this show. I'm sorry if I missed you. Thank you so much for giving this episode some love. And good luck with your investments. Good luck with this last quarter. Take care.